to Franklin Templeton, chief market strategist and head of Franklin Templeton Institute, Stephen Dover, who has $1.74 trillion in assets under management. Well, you're ahead of Marvell at the moment, which is not quite at $1 trillion. Stephen, right away, when you hear David Solomon saying, hey, the capital's there, take it, is there anything about that that worries you at the moment, especially in light of this Alphabet $80 billion equity money grab, I guess?
Well, yes, there is. Thank you for having me back on the show. Last time I was here, I was very positive on the market, mostly broadly. And we're still generally positive on the market. But yes, we have some concerns and think there's likely to be some consolidation. I think that the big show that we're going to have in the next few weeks will be these IPOs, which are, in essence, what he was talking about, a big grab for capital.
Grab for capital. And just because it's there is liquidity in the system, as David Solomon put it at the Economic Club. Should you worry when you see that one of the companies you're invested in is taking it, or is this the perfect time to be expanding when there is so much demand in the AI world?
So we take a little bit different approach on that in terms of being positive on the economy and the market overall, but being a little cautious on some of these higher flying opportunities. I think that in many cases, the corporate investors or the institutional investors have already made their capital contributions, and now these are being opened up to more retail investors. So that leads us to have some caution about some of these fundraisers. I
want to bring the topic to Hewlett-Packard because, listen, you talk about demand. Hewlett-Packard had a 40% year-over-year jump in the revenue, specifically to $10.7 billion. Nearly $8 billion of that $10.7 billion came from Hewlett-Packard Enterprise's cloud and AI segment, which does include servers. So somebody's clearly scooping this up. But this is what caught my eye. A Morgan Stanley analyst, after looking through the earnings numbers, noted that, quote, large enterprises are pulling forward server demand to get ahead of supply risks as servers become increasingly important in an agentic world. So in essence, are we seeing that everyone's just buying things up just because, at least for the moment, they are there? This reminds me of the silly bands craze back in, I don't know, was it 2007, 8, and 9, when the kids were running around scooping up all of these stretchy bands that fit around your wrists, and then suddenly there was a big dive in the price at some point?
Yeah, but even more disconcerting, that's what we saw in 1999. Again, we're overall positive in the market, but we're cautious on some parts that seem a little bit frothy. One of the issues around the IPOs that are coming out is we're going to get more data. We're going to have they'll have to have financial disclosure. So we'll see more sense of what's behind. But certainly at this point, there is a shortage of chips. There's a shortage of energy. And so there's massive capital development. Almost certainly there's going to be too much capital going into that. A lot of that capital will not get very good returns. We would not recommend thematic investing, as I guess a previous guest did, in terms of being pretty narrow in the market. I think there's just a great deal of risk in that.
Yeah, we were just showing Dell stock, which is not quite, where we should be going. We should be showing year-to-date, if we can, Dell versus HP. Both of them had incredible year-to-date runs. So again, when you talk about high flyers, and I know you don't go individual stocks, but would they fit into that category?
They'd fit into the more broadening category. And I think it's important to note that the earnings growth for the S&P 500 overall is up about 10%, and the S&P is up about 10% year to date. So PE has in essence remained flat for the market overall. So and when you look at these specific companies you're talking about, where that's not the case, where the market has outrun the earnings, that's where we would look for some caution, especially for long-term investors.
Really quick, we're getting economic data tomorrow. The ADP jobs report. This is the private employers report that is the precursor to the May Labor Department report that comes out on Friday. It's interesting to see that the expectation is 110,000 jobs added last month versus 109,000. So not a lot of growth there. Does anything about the labor market worry you at all?
Well, this week's numbers on the labor market are going to be important for a couple of reasons. It's really going to indicate to us where interest rates are going to go. So far, the labor market's been strong enough that we think interest rates are likely to stay flat or even potentially go up. But any super weakness in the labor market is going to be a problem. The second problem, I think, really is going to be political, and people don't have jobs. But coming back to what you're saying before, I think probably a very big issue we're going to have to look for in the next year or so is the backlash against AI politically.
Yeah, we've been talking about that. Some communities do not like those huge server farms. That is right here in front of us now. All right, good to see you, Stephen. Thank you very much. I want to let our viewers know I'm keeping a very close eye on the NASDAQ.